It is time to check in with Amanda Lang, our business reporter with BNN Bloomberg. And of course, you can follow her across the Iheart Radio network. She also is the host of Taking Stock. So, Amanda, a pretty busy week in terms of finances this week. First of all, the Bank of Canada rate cut that a lot of people thought, analysts thought might be coming. It did. But then today, jobs numbers come out. So kind of flat, Canada adding 27,000 jobs, which I guess begs the question, given that, and given the fact that analysts still think there are more rate cuts coming from the Bank of Canada by year's end, what does this job number play into that?
Nothing about today's job number changes the bank's thinking based on what they told us a couple of days ago. So the bank essentially said, we're at the pivot point. We feel really good about the progress we've made on inflation. We are going to watch really closely to make sure that nothing kind of jumps out at us. But the trajectory we're on here is good. So they're cautiously saying, look for more rate cuts. And I think most economists are looking for at least two more between now and the end of the year. Some are only looking for one. This jobs data is weak. We're not keeping pace with population growth still. And so we do have that the unemployment rate ticking up another 0.1. So we're at 6.1 now, 6.2. And that's, generally kind of a weak outlook. So it leaves the bank free to cut rates further in July.
So I'm watching, when I did the story this week, Canada, of course, and I think the finance minister made a deal of this, saying, we're the first G7 country to cut rates. A day later, the European Central Bank cut rates. And then today, jobs numbers out of the U.S., exceedingly strong, which kind of means they're not going to be cutting rates anytime soon either. How does all this kind of play into itself?
That is the most complicated part of this whole situation for our central bank, even more so than the Europeans, although it'll be similar, which is, our currency is valued based off the U.S. currency, and a lot of the things that our businesses buy are priced in U.S. dollars. So if our dollar gets weak, which happens when you cut your interest rates, you can actually create inflation. This is the kind of the unfortunate side effect. If the U.S. dollar is super strong and everything we buy in U.S. dollars is therefore more expensive, we've just created inflation. So our bank is watching it. They did say this week they're not overly worried about going in front of the Fed. But wow, the U.S. economy has just been, I don't know about you, but I've been blown away at how strong it has remained on the jobs front, on the productivity front. Consumer spending is still robust. Business investment is still robust. So there's not really any signs that it is doing the same slowdown that we're doing. So that could create an issue for us as we go ahead.
You know what I find fascinating as you talk about the U.S. and just how strong their economy has been. So we're heading into an election there by November. And people there, as well as the economy has been doing and their jobs numbers have been incredible, people somehow aren't buying into the fact that the U.S. is doing as well as it is economically, which I find fascinating. The message doesn't seem to be getting through to the average person on the street.
We saw that here too a little bit. The sentiment was weaker than the actual facts for quite some time. Now the weakness is kind of, it's true. But again, it's not that bad here either, right? We did manage to avoid a deep recession. It looks like we may well, if there's no other kind of big external shock to our economy, we look like we've sidestepped any kind of real massive contraction in economic growth. So that's a really good news story. This was the first time our central bank governor, Tiff Macklem, had a chance to lower rates in his entire tenure because he came into this inflationary environment. And so we should applaud a little bit the work that they did, although we'll also say they may have waited too long to start raising rates.
I'm wondering if I can ask you a political sort of question here. What did you make of Chrystia Freeland when the day this was announced, coming out and basically congratulating the government for having helped do this?
This is just politics, right? Are we surprised? If this had gone the other way and it was a bad news story, they would have been very silent. I think it's completely to be expected that when good things happen, politicians will take credit. Is that fair? I don't know. They definitely continue to spend way above pre-pandemic levels, which is inflationary. So that's all still kind of in the mix. So they certainly aren't acting in a way that would contract our economy.
Let me go on to talk about a story, and this is interesting as well, given the times we're in here, and I'm talking now from the Canadian perspective. We hear about companies closing, companies downsizing. Then there's the announcement that Simon's, a Quebec-based retailer, is actually expanding, which, in and of itself, obviously sounds like really, really good news.
It does, and it's expanding into two locations in just the Toronto market, for example, that they're big, important anchor malls, the Eaton Centre and Yorkdale, massive footprints. I'm curious to know what you think about this. Simon's is obviously a super strong brand. It's a great retail experience. It's a notable one. Can it succeed where others failed? It's moving into the empty space that Nordstrom vacated. So it's not as though this is new retail space. There was a retailer there that didn't make it work. And I guess the question is, are they going to catch the right moment where people go back to the malls and foot traffic picks up? I hope so. I hope this is a sign of good things because remember, it's not just Simons, but it's also the owner of that mall, which is also a bit the commercial real estate market is concerning because of rates have weighed on them and occupancy has weighed on them. So it would be great if this was a signal of optimism. It might just be a signal that Simons is very optimistic about its own abilities.
Yeah, I shop at Simons here in Montreal, and I like Simons. The one we have downtown, which is now in the old Simpsons building from way back. I like it because it's actually a smaller department store, and I know that's not the same footprint depending on where they happen to be in different parts of the city. They also have a really interesting brand mix that you simply don't find in a store like the Bay, for example, at least when it comes to men's fashion. Be curious to see how they play out in Toronto. Two giant malls, as you said, and whether the sort of taste there reflect the ones they already have in Quebec.
Yeah, and then, the truth about the Quebec market in other realms, not just in retail, but it's true in cultural realms, is there can be a really strong, the Quebec film scene is super vibrant and the music scene is super vibrant. And does it export well is the question. I agree with you. Simons feels very curated. It feels like boutique-y, except at a big scale.
That's a good word for it.
They've gone out and selected things for you, which is a really nice feeling. And hopefully people, go because they want to experience that.
We shall see. Let me get to one other thing really quick. Average rents in Canada now beyond the $2,200 level. First time that's ever happened. Obviously, Bank of Canada looking at that as well. That costs money to finance. So I wonder if that factors into their eventual decision. Do you think it does? I know we've talked about rents before.
I think absolutely the bank, one of the calculus that they're now looking at is that they are the thing causing sort of a pain point for many. Now, rents are really now driven by, two things, right? People can't move out of the rental market and into housing, but that's driven by not just the mortgage market, but by supply and demand. And both of those fronts, really, interest rates are still too high to cause real relief. Developers aren't going to say, oh, wow, a quarter basis point cut. I'm going to go build a building I couldn't afford last week. They're going to need a lot more if that was sort of their dividing line. So I think we're still going to see a bit of a mismatch of supply and demand. We're not building enough. Yeah. We're not building enough rental units, although in some markets that's what's being built is multifamily, and hopefully that continues. We're just way behind. So unfortunately, this rent affordability problem, I don't see it changing, and I don't see rates coming down making much of an impact on it.
Yeah, no time soon. Last thing really quick, world's really rich or getting richer, and it's nice to see that apparently includes Canadians.
That's right. This is one of those stories that Capgemini does every year. So this is their 28th annual World Wealth Report. And the high net worth individuals globally saw their wealth up 4.7% last year. One big reason for that, of course, is if you own assets, it's often in stocks or, there might be alternative assets like real estate. And they've been going up. And so if you have the money to have assets, you're likely to gain wealth. If you only have income, which of course most working people do, then it's harder to gain this kind of wealth. And that's what was really writ large in this. So we did see that as well. Canadian wealthy high net worth individuals up 3.8%. So not quite as much as the global number, but not bad at all.
Amanda, that's where we're going to leave it. Thank you so much. Appreciate it.
Great to talk.